to do here. And now I'm going to go live. And I'm going to go back to here. Are we live? Are we live? Hello. All right. Welcome to the first live streaming of Great Report episode. Joined by Dr. Matt Bastnagel, Director of Communications and Marketing at Great Capital. How you doing, Matt?
Pretty good.
So we're doing it live because the Fed is going to come out, a little presser, and tell us about what they're doing with interest rates.
I like to think that they spend the month before the presser comes out. They're just carefully constructing the words that they're going to say.
Well, do they know? I mean,
nothing out of place. No, they know a month. They've known for years what they're going to do. They're like prophets.
I mean, that would be nice. It's nice. They're not as data dependent as they claim.
Yeah.
So the news of the week, though, is we had a CPI print that came out yesterday, Matt.
Yes.
That was a little bit of a surprise because it came in. Well, I guess it depends on what headline you read. You can either hear the inflation is still incredibly strong. It's up 4% year over year.
Yeah.
But also you can read the headline that inflation is growing at its slowest pace since March 2021. Yeah. Because the month-over-month growth was only 0.1%.
Yeah.
So that's 1.2% annualized.
Yeah.
But going back a whole year, we're at 4%. What?
Yeah.
Read between the lines, Matt. What say
4% still is elevated. If you're talking about like a real number, it's above the target. Yeah.
2x the target. Yeah.
But I think that if you look back at the history of where inflation has been, last month it was up 0.4% in a single month. I was getting scared. And then we had the huge jobs numbers. I was getting more scared. But now, only 0.1, which is really low. If we had a full year of 0.1s, we'd have like, 1.5 or something inflation in general. So
for the summer.
Yeah. So, and the other thing, too, is year-over-year inflation last month was 4.9, and now it's 4. Yeah. So that's a huge drop in just 1 month.
Yeah.
I think that it is great news. I think last month, if anything, there was more optimistic things because it like nominally got year over year nominally got lower.
Yeah.
But month over month, like I think that was like a false hope of last month. But this month, there's not much bad that I can see in it.
Yeah.
The only bad thing that I think, and you told me a couple days or whenever we learned about it, energy prices. Energy prices were down significantly this month, and I'm wondering if they're going to come back up because Middle East is going to cut oil production, or what kind of impact that might have.
Yeah. I mean, I think one of the other headlines, and I'm glad you brought it up, Matt, is core inflation. When you strip out the more volatile, as they say, food and energy, was up quite a bit more than. If you strip out food and energy, the CPI was up higher because food and energy have actually come down significantly.
Yeah,
I think we were talking about this yesterday, and you were a little surprised because you were like, "Oh, I thought energy was going to start creeping up because the Saudis are reducing, their drilling or what they're producing." And I think, I was reading articles yesterday that maybe natural gas might start, another bull market. So I think, I don't think the story's fully written, but right now, today, food and energy prices have decreased, substantially, and that's keeping the overall basket, relatively, coming down. But are all those other pieces of inflation now? If you look at kind of the non-core, you're actually just looking at if you're looking, is everything else staying sticky and staying high?
Yeah.
That's the question. Shelter being one of those, which I know we'll get into and talk about a lot.
Yeah. I think that at least for the CPI, when we're talking about core and not core, the shelter is it's an even bigger, slightly, but a bigger component of core because you're stripping out food and energy.
Yeah.
And if you just back of the napkin math, shelter is about 8% of the total for core or for inflation period for all items.
It's 30%.
Or I think that's shelter. So
all shelter.
But for rent of primary shelter, which is this discrete category that's kind of the apartment market, is that is about 8% of the total, maybe more or less 10% of the core. So if you're going to move 5%, which I think is totally doable, then you can so it's about 7.5%, I'm sorry, of total. That's the weight that we see right there in the middle, under. So that's 34, which rent of shelter I think also includes owner's equivalent of shelter. But rent of primary residence is 7.5 weighted, is as part of the total, and maybe roughly, I would say it's 10% or so. Basically, though, if we go from 8.7, which is their measure of rent growth, if we go from 8.7 to a more normal 3.5, then that's like a half a percentage point off of the inflation numbers right there. Mm-hmm. And that's almost expected right now. I think that we are at, I think rents, the way that CPI has measured them is are starting to come down. Yeah. And that's, I think, the kind of broader story when it comes to...
And that's what we've been talking about all week, Matt. And, we've been talking about this theme of these, come variable lags and how they can be very confusing and all these base effects that come to place because the way that CPI is calculating rent, the way that they're looking at it, is more reflective of leases that were signed last year. And so we're really capturing more of market rents 12 months ago. Yeah. It's not exactly like, it's not like the price was 12 months ago, but that's closer to what it's measuring rather than like the market rate in rents today. Yeah. Because we can see that, we know looking back, rents were growing very strong really until about like August or September. Then August, they started declining. And so, we would imagine we would see, that's when we'd start seeing the slowdown in CPI around this year in August and September. And so it's not surprising that we still see relatively elevated levels. And also since rents were still rising, we have that base effect. Mm-hmm. And we also know at the end of last year, kind of Q4 and then halfway through Q1 of 23, we saw rents decline. Demand was at its lowest level, in more than a decade. So there's going to be a period. We can see this happening, that, this fall and this winter, we should see very slow growth. It's going to seep into CPI. And so again, there's going to be articles about how like rents are declining.
And then you'll know that rents are going to start to grow.
And they probably are. I mean, now today, we have this Wall Street Journal article, Matt, which, we can really get into. I've seen it circulated.
Yeah, we'll split it up into two, I guess.
Quite a bit.
If the Fed starts talking about something important.
If the Fed starts talking, but I think just before, the title of the headline of this piece is "Renters are about to get the upper hand," like they're just getting ready to. Mm-hmm. But in the reality, they've already had it. Renters had the upper hand last fall and this winter, and no longer because rents are increasing substantially. And so I think this is a little bit of a clickbaity headline, but it's been widely read. It's been sent to me by a handful of people, but I think they just missed the analysis, and I keep finding that folks, journalists that cover a lot of different areas of the financial services or news, and then like they throw housing into it, or maybe housing isn't their beat. That they can get some of the nuance wrong, and it's a good article, and they do some of the work that Matt that you've been doing actually is that they're taking some of these new lease asking rent prices and they're putting them all together and comparing and kind of looking at an average, which is really good work. But their analysis really just is they're in their conclusions is a little bit off. It's like their U.S. rental market is slowing down after an unprecedented run. Again, this article would have been appropriate in February. Yeah. But now, if you go look at CoStar, and I don't have the numbers pulled up right in front of me, Matt, but I could get them.
It would be appropriate in February. It'd also be it would be appropriate last September. Yeah. If they really wanted to catch the trend.
Exactly.
But what I think is interesting about the Wall Street Journal is like, I think that they do open up a little bit to like the idea that they're going for a more mainstream market or a mainstream appeal. And if you look at the CPI, which is CPI measures renewals and market rents. Yeah. So that's what kind of makes it a lagging indicator. But I think I mean, as CPI measured rents go down, then renters in general are going to feel better, but they're not going to get the upper hand because when you're talking about upper hand, you're talking about the market negotiations of new lease rents. So it really is an inaccurate headline.
I know. Sorry.
No, that's fine.
If you saw that presentation, you're like, I'm interested in those slides. Go watch our last YouTube live. We did it last week on Tuesday. We did a whole live on upcoming loan maturities in the multifamily market. Matt, let's check on the presser. Chair Powell to speak any moment, and I saw something across the Chiron saying maybe the Fed could even increase rates. I don't know. I think because the consensus right now, not to go back and forth, but the consensus right now is that there will be a pause.
Oh,
there'll be a skip.
I heard there's a 7% chance of a 25 basis points increase. That's the one that I glommed
onto. 7%?
7%? Yeah, 7% odds, like betting odds.
Mm-hmm, because, I was interviewed, Matt, last week by Multi-Housing News. It's, will the Fed finally pause interest rate hikes? And then they asked me for my opinion, which I was humbled to provide, but I'm like, I don't have a crystal ball. I don't know. There's so many moving pieces, and what should happen, and what I think is going to happen aren't necessarily the same thing.
Yeah.
And I was a dissenter saying that I think, there's a good chance it'll plateau, but I'm not ruling out a 25 basis point increase, for the idea being that the Fed and Jay Powell need to restore confidence at the Fed.
Yeah.
Because, transitory inflation, the whole idea that it's transitory got away from them, and they kept rates at zero for far too long, and it got them in a lot of trouble. And so they need to say, hey, no, we're serious about this. Again, you can trust us. We've got this under control. And they seeing economic growth, unemployment rate so low, can they get away with another 25 basis point increase to really just nail that coffin down?
Yeah.
The hole in the coffin to say, let's put this thing to bed.
Because
let's bury it.
And
right here, we got Jay Powell coming out.
Here we go.
The answers. Let's head it over to Fed Chair Jay Powell.
Are we getting the audio through this too?
Good afternoon. My colleagues and I
right.
remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Just went from 7 to 14.
Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
All right.
Continue to reduce
Looking
securities
ahead,
holdings.
nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over
Here we
time.
go. Still be
We're
scared.
just going to
And I will
pause.
have more to say about monetary policy
be scared.
after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer-run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year.
Is he patting himself on the back?
While the jobs to workers gap has declined,
after this,
labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%. Excluding the volatile food and energy categories, core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile and food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
If you anchor inflation,
my colleagues and I are acutely aware that high inflation imposes hardship
tend to drift away.
as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take economic activity and inflation and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum mobility goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, Matt, this was not
Thank you,
shocking.
Colby Smith with the
Not
Financial
shocking.
Times.
Let's listen to a couple of questions and
I'm
we'll
curious
get into
what gives
multifamily.
you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were three issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including
was to emphasize
we did not decide
staying high is still bad. It's not going down.
Approach.
Yeah,
We were really
let's maybe talk about that for a little bit, Matt.
Yeah.
And we'll probably fade off from the press conference just for now, as we'll go back and listen to some of these reporters' questions kind of at a later date. But Matt, let's talk about multifamily. Let's talk about the effects of the fact that the Fed funds rate is being plateaued in a range of 5% to 5.25%. That is great news for borrowers that have floating rate mortgages. They're going to avoid paying another 25 basis points more a month. But the question that I have for you, Matt, is how consequential is this? What would have been the difference if they raised interest rates 25 basis points? Does it matter? Have we already passed the point of no return, or does this signal an inflection point in a change of something different?
I don't think it. I think that they had their target in mind. I mean, just as much as I joked that they had it 2 years ago, but they did have their target a long time ago. They've kind of been telegraphing
to last year's Fed dot plot and see.
Yeah. But as we say kind of every month, they don't take too rash decisions, although I think that there is an emotional valence to an increase rather than a pause. I think when that woman was asking her question, she wanted to know if I almost think that she was saying, okay, you're pausing. Shouldn't you raise? Because are people going to get too excited about pause? At least that's what I'm thinking.
Yeah.
And that was a lot of in Powell's, when he was reading stuff, when he was reading those strong jobs numbers, it was like, okay, jobs are okay. Like just the way that he's delivering this information is kind of funny.
I mean, we were pulling up the S&P 500. Today, it dropped right before, but it's gone up since. But I mean, Matt, the S&P 500 has been doing really well, and after having a horrible end of the year last year and beginning of this year. So I mean, it's a decent question to say. You're saying that we need to slow the tightening down and keep it where it's at. But man, things are running so hot right now.
I know that's what.
Is there a sign that there's just too much growth in the system? And we need to continue to address that with rate hikes. I
mean, if it's hard for me to not think that. Because there was a lot of the figures that he gave, he's talking about lower GDP growth expected. He's talking about higher unemployment expected, and he said, and this I think is a key quote, it will take time for the effects of although it's been nearly a year.
It's been over a year since they've started.
Yeah.
But it hasn't been a year since things have gotten really high and tight. Now, those first increases were big. Those were big increases. But yeah, it's going to take a while for it all to seep into the system.
And by saying it will take time also carries an important and powerful implication that it is going to stay high. Because if it's not, he wouldn't say that. I was like, it'll take time for these effects to be filled, but don't worry about that because it's going to zero by August. Like that's not going to happen. I think that he was trying, a lot of it was trying to bolster the feelings of people like you and me who are saying, well, maybe things are running too hot, because he talked about how when they increased it, look at how fast I increased it.
Yeah.
And I think that was the spin, at least the kind of emphasis and tone that he was trying to say is it seemed like an acknowledgement that things are running still hotter than you'd think given the CPI numbers. They're running hot,
but just thinking back to what we were just talking about before the press conference started, they know what's going to happen over the next couple of months.
Yeah.
They know against some of these, the variable lags like housing is going to start seeping into CPI in the next couple of months.
Yeah.
And so they're saying like, look, we're comfortable with the way things are right now. I got another, I'm loaded though. I got another bullet in the chamber. Like we got it.
Yeah.
We'll use it if you make us use it. But he has to signal the market. He has to say we're ready to continue to do more. It can't pivot. There was all this talk about the Fed pivot. It's not a pivot. It's a, we're pausing and we're ready to keep going. Or again, that's at least what he has to message.
Yeah.
But I believe in their mind they're done.
Oh, you think so?
In their mind, I think that there is a possibility that sure, things can change, but I do think that they believe, and it certainly could be correct, that they have achieved the soft landing that they were hoping for.
Yeah. I was just thinking about that when the CPI numbers came yesterday. I was like, this is it? I mean, employment's high, CPI's low, but now I got to feel nervous a little bit because there's something mismatched about that, and that's what I want to wait for this to kind of resolve itself. But there is a lot to be said about the duality of high jobs and low prices.
Well, I think he mentioned the duality at the beginning by addressing the fact that things are still strong, but we have these long variable lags, and things are coming down, and so we have to acknowledge that, and we have to acknowledge that in the future we know some things are going to come just down in the numbers, but there's still a risk out here because of unemployment, and we're aware of that. But in the only way to thread the needle, this needle of the economy that we're dealing with post-COVID, post-pandemic, it's gonna look confusing and it's gonna look double-sided and it's not gonna be clear-cut. So whatever the solution you think maybe could have been, it was always gonna be this messy. And I think it's so funny, or it's interesting how certain so many sources can be and experts when we're hearing, we've heard that soft landing is an impossibility multiple times. We've heard that it's certainty. We've heard that a recession is. I mean, when I start seeing 100%, I'm like, what do you mean 100%? Nothing. What is
Wall Street Journal?
What is 100%?
Yeah.
Like, what can you really truly say is I'm forecasting an event into the future? Because nothing is. I mean, nothing is certain.
Yeah.
You know, you could be 99.999. There can be a lot of nines, but it's never 100.
It is interesting to see that. Their March projections were that the economy would be doing a little worse, I think, or at least they were. And I think that was maybe in the midst of a lot of the banking crises, but also like. In general, there was maybe slightly less confidence. I feel like we are at this weird. We're not scraping by, surviving. We might not necessarily be growing at the clip that we were growing like last year, but like the more that we're in this state of like, are we gonna do bad? Like, it's like if we spend a year doing that, what is that year?
Yeah,
that year's a decent year.
It's the fog of war, and it's where I think we're going to start seeing opportunities as the dust begins to settle. Yeah. But there's still dust in the air. Is where you're going to have to start striking while others are still on the sidelines. Yeah. Because we know it's hard to find opportunities and make opportunities work, and there will be some people. It's easy to fall into this go down this path of just kind of getting defeated and just assuming the market doesn't work right now. Yeah, and being like, there aren't any deals. There are no deals. Yeah, there are deals in every market. It just might take a little bit. Thinking about it may take thinking about it differently. Yeah, it may take looking harder. It may take looking at different places. It may take changing your criteria a little bit without changing your kind of standards of risk. Yeah. Maybe it takes examining that as well. But there's always deals, and we're going to be approaching. I certainly hope, and I do believe this. We're getting closer to a period of where the deals will start emerging, but there's going to be 50% of the market that still is going to be pencils down, believing that there are no deals to be done. Yeah, and so that's where that's going to be an opportunity. I don't know if we're. I don't know. I don't know if it's right now. I think we're getting pretty close though. And
it's so weird. And just to kind of come back to that Wall Street Journal article, some people think that we're headed down. And other people think that we're headed up. You say that you see the same figures and you're either at the top of the mountain or you're starting to climb up it.
Absolutely, Matt. I sent an email right before we got on, and so I know it's like not included in this, but it was a piece from CoStar. Yeah. And basically the email was it was describing all of the different potential recession forecasts, and including one of their own. They use Oxford Economics as their macroeconomic data provider, and they have their own forecast. And Oxford Economics, they're projecting a recession in Q4 of 23. There's a lot of predictions for recession in Q4 of 23 or Q1 of 24. Basically, end of this year, beginning of next year. But it's all over the map. There is no consensus. There's just not a consensus. Yeah. And now again, I don't know what all the right moves are, but I do know that in that type of environment, there's a lot of opportunity and there's a lot of money to be made. Yeah. Yeah. Because when the market's not sure what to think, it's you just have to kind of filter through the noise, which is way easier said than done. But if you can, you can find some opportunities that
it almost makes me think people are looking for the post-financial or the financial crisis for a antecedent or for an example, and that happened so quickly. It seemed like things started tumbling down with Lehman Brothers and all, and then you heard about the housing market just crashing. But that was so dramatic and discernible, and we had such a source. Now I think the source might be office market and commercial real estate potentially. But right now, no one's like, oh, we're building to something. And the people that are saying that are the ones that say it every year, every week. Yeah. But it's hard to find the sort. There is, consumer credit, revolving credit is a little bit high, or is high, but it's not skyrocketing up. It's just trending high.
I do think that there is. We'll have to see what happens with all the loans that are coming due at the end of the year and beginning of next year. And then whereas outside of my pay grade is all of the derivative products behind all those loans and all the, the synthetic derivatives that are, you got your property, you got your loan. Okay, well, that bundled up, and then how is that broken out and further securitized, and then again synthesized and then chopped up and moved around and then levered because the idea is that these multifamily loans, the foreclosure rate is so low. The default rate is so low. It's 0.2%. It's a fraction of a percent. They're even equity investors have seen multifamily as one of the safest bets and most risk-adjusted returns. There's risk in everything.
Office used to be seen as a safe bet, though, too.
True. Well, and people were moving away from office, and because office was the darling of, for the longest time, commercial real estate. You think of commercial real estate, you think of office.
Yeah.
And multifamily just seemed like was always this black sheep. I don't know. This other sector that was like a little, I don't know, just less clean because it's like you had to deal with the everyday person.
Maybe. Really? Okay.
It's
was it less corporatized because?
Well, one, yes, less corporatized, much more mom and pop.
Yeah.
Because you're dealing with people. You're just dealing with people. You're not dealing with companies. Office and industrial. Folks like that because it's like you're not dealing with evicting somebody. You're not dealing with qualifying them for income. We're not dealing with kids running around. You're again not dealing with tenants and toilets and all that. You're dealing with a business and their needs, and it's much more straightforward. It's less services and operations.
Yeah.
But then but those problems don't always end up being to lesser returns on the multifamily side. People are making a lot of money doing it, and it's actually the economics of it are very attractive from a risk return perspective because of just what the demand is. There's always someone that needs a place to live. You can be in balance, but typically over time, the housing there'll always be a degree of housing demand. Not that you can't have too much.
Yeah, and that's can't necessarily be said anymore about the office market.
Yeah, no, it's not. You don't exactly. You can't say a business will always need a place to meet and get on their computers.
And there, yes, this floating rate loan issue where the loans are coming due for office and for multifamily. I wonder if there is going to be a little bit of a difference with the office market because their leases are longer term. It's not necessarily every year like a renter, maybe a business based 5 years. So I wonder if they could kind of still limp along for longer, maybe but still.
Well, if their loans coming due, the loans coming due.
Yeah, but if they're getting that, if their 5 year, if their loan's coming due, but they can't find another tenant, that's a lot bigger problem.
Yeah. Well, they are both. If there's money coming in, maybe the bank will work on an extension or a modification, or I mean, it's not going to be good. I mean, because they're going to be you took out a $10 million loan because you thought that the property was valued at $13 million. Now the property is actually valued at $5 million.
I mean, thinking about what if
$5 million?
What if demand for office is permanently down 10%, even just 10%?
Yeah,
that's not. No. That doesn't bode well. And I don't know.
30%.
I don't know what the number is. But when there was a housing crisis, people were still living in houses, just couldn't pay for it. There was a big deal. But there's a lot of money tied up in office market that people may not even use.
Yeah. Well, and it's and again, it's this financial crisis, so it's the multifamily and the office side, and who are the investors in those products? It's big institutions, it's insurance companies, it's banks,
like pensions and stuff.
The pension funds, insurance companies, banks, because they're okay, they have all these assets where they have to allocate it somewhere other than cash and just 1 month treasuries, and they're looking to get a little bit of yield
for low risk, right?
Yeah, exactly. So they're thinking low risk, and so they're looking out and they're like, oh, well, think of it 2 years ago. They're like, okay, well, I can get nothing even on a 10-year treasury. I'm getting 0.5%, maybe 8%. But maybe I can go out and buy some of this, MBS or these CDOs.
These are the securitized loans for commercial real estate.
Yeah, mortgage-backed securities or collateralized debt obligations. And I can, so it's pooled of mortgages, and I can get 4%. 3%, 4%.
Yeah.
Well, it's a lot more than I'm getting in treasuries. And what's the default rate on these? It's next to zero. And then let's lever on top of that, and maybe lever on top of that, and lever on top of that, and then lever on top of that, and lever on top of that. And again, I don't know. Like, I'm not the expert in that area, but I know
that's a good point, though, because the way that risk has changed, this massive shift of like, well, now office seems a little more risky, but before you could maybe up your leverage if it was more risky. Then it's like, well, things aren't going to go upside down. It's office. Who's going to stop going to work?
Absolutely. And people did the same thing with multifamily too.
Yeah.
People are like, this is a great location. Multifamily is a great asset class. You're a great sponsor. We know you. Rents are growing. Mm-hmm. Interest rates are low. Interest rates are going to stay low. Rents are going to keep growing at 20%.
Yeah,
we'll give you an 85%, LTV loan, interest only.
Yeah,
and we'll also give you $1 million of, line of credit, and you're going to be buying at that 3.8 cap.
Yeah, that's trouble.
And again, that's not the whole. That's not the whole market.
Yeah,
it's a part of the market, but it's definitely a part of the market, and that's where the pocket. There's going to be the pockets that just do the pocket spread.
Yeah,
we know there's a lot of people who took on too much risk, and the math is too far the other direction. Like, the math doesn't make sense. The hole's too big.
I remember you were talking about this as outside of the Gray report, but you were saying, if there's all this trouble with the office market defaulting on loans or troubles with financing office properties, do you think that's going to make the banks more liable to lend to multifamily or less liable to lend to multifamily? It's going to be less.
Credit is not going to be looser.
Yeah.
There's not going to be more money like floating around to save people who've made mistakes. Like, will there be some? Certainly, and who's connected and whose friends are friends of someone. Mm-hmm. But it's all correlated to some degree. I think there's a good chance that multifamily gets by with again, pocketed distress, pocketed foreclosures, the market coming down 5 to 10%, the deal's starting to make sense over time. Maybe not all at once. There's going to be a few examples of fire sales that happen, but it's not going to be the market. It's going to be a couple deals over here, a couple deals over there, and then it equalizes probably in the middle. Like you had right now, what's going to happen? But without a doubt, again, so what I think, conclusion, and I've talked about this the last couple of days.
Yeah.
The Fed pausing, the Fed increasing 25 basis points, it's sort of inconsequential. Mm-hmm. It will help or in effect several folks on the margins.
Yeah.
On the margins. But for most of those who were on the margins, I believe that they can figure things out, and they probably would have made it either way.
Yeah, I agree totally.
So, there is a percentage, and we don't know what the percentage is. We haven't been able to figure this out, and it's the big question: is who are those that, again, the hole's too deep?
Yep.
It's not they have to bring the 15% of the equity or 20. It's not that they have to bring a couple hundred or $1 million. It's like the equity raise was 5, and they have to bring another 5. Like they have to bring 100% of what they had raised or more, because they were 85% levered or more, 90% levered somehow. And they had pref equity. Maybe they had multiple equity classes. And there's going to be some investors that lose. There's already been investors that have lost. We detailed in the Apple's Way investment.
It is interesting when you're talking about that much leverage, how just like a little shift positive, then you're saved. But then if it gets negative and you can't figure it out, then you're hosed.
Absolutely.
And honestly, if you're talking about if people think that they will survive this high interest rates, it's there's just not enough time for it to go back down in time to save everyone.
Yeah.
It would take a crisis that would also be bad news for these investors as well to have the Fed go down that much. And I just do not think that that's going to happen at this moment.
Yep, agreed. Well, Matt, this is a great little test run. We had a couple folks join us. Griffin, thank you for hopping on.
So much more I wanted to talk about too.
I know. Well, we got next week.
I've got. I just want to tease this a little bit. Wall Street Journal had tracked 5 different private rent trackers. We've been tracking at least 8 or more.
Yeah.
And at a level of sophistication that is going to just dazzle you. I'd like to tease that for sure.
Yeah, Matt definitely feels attacked because because and I saw this. I was like, Matt's gonna not like this. So we're working on a report that like compares all the different rent trackers, and Matt has been aggregating and tracking this. And Wall Street Journal has attempted to do the same. I don't know if they saw yours, Matt. That is probably what is usually the case.
Yeah, we were talking about that, and just one note that I wanted to include while we were talking. They say that rents are on the way down, but if you look at the month-over-month rent growth, which is what we've been tracking, month-over-month has steadily increased and increased and increased. So this downward trend, it doesn't look great on that chart, but
I think they're just
honestly,
looking at year over year.
Yeah,
they're just looking at
they're
year
only
over year
looking at year over year,
month over month.
Yeah, I know, but that's what they leave out of their discussion.
Yeah, exactly. They're showing a picture, and then, but this is from CoStar.
Yeah,
this is daily rent per square foot.
Yeah.
So if you look in perspective, like they're showing this piece right here, like they're showing this.
Exactly. Yeah.
They're
it is.
showing that they're showing this decline down to the end of the year. They're not showing this 45-degree angle to the right.
Yeah.
Up and to the right.
Yeah.
So again, you if you want to know, here's the conclusion, and then we're going to leave it on this. Because then we've got an exciting interview that's going to be posted later with Director of Property Management here at Gray Residential, Katrina Green. Is if you want to find the best information, not just like information, but you want to find curated.
Here's what to ignore. Here's what to notice.
Cut through the noise. Come to the Gray Report. That's what industry leaders do.
That's right.
That's what owners and operators of tens of thousands of units. We probably have. I'm doing some very quick math here, Matt. Probably have owners that I know of personally.
Yeah.
Probably 75,000 units. Though I know, watch and listen to the Gray Report. We're probably for the field that I'm not 100% sure on is probably pushing 100,000.
All right, let's keep them growing.
At bare minimum. And that's like, and there's a couple of those that are made up of like 20,000 unit chunks, 20,000 unit chunks.
Yeah. So
if you want to get the information from the same place that those folks are, you just keep coming back to the Gray Report. Sign up for the newsletter. Hop on over to graycapitalllc.com/report. And we've been talking a lot about these loan maturities. Yeah. You saw the YouTube live presentation that we did last week. But if you want to actually get that report so you can review it yourself, just hop on over to graycapitalllc.com/report. It's really easy to do. It just takes a second. Just drop in your email address, your name. I don't even need your last name. We just need your first name. And then anyway, make sure you're not a robot. You're going to get sent this report, and it's going to give you all the information. Again, this is on the live, but I mean, oh my God, it's just data and just straight to the point. And Matt Bastnagel is involved in it. And if you miss this, you're going to just have a gap in your knowledge base, and you're going to be flying blind.
Yep.
So, all right, thanks again for watching this Gray Report Live. We'll be doing these again. I don't know if everyone's going to be live, but we'll be doing them more.
Yeah.
We'll figure it out. And
this went a lot better than I thought. I'd be terrified to go live.
Matt was a little nervous, but we did.